Right now, open your banking app. You see a number. Maybe it's 50,000, maybe 5 lakh, maybe more. That number feels real. It feels like yours. It is not. Not in the way you think. Not in the way the system wants you to think. And the uncomfortable part? This is not a glitch. This is not corruption. This is not a conspiracy. This is exactly how the system was designed to work. Swap. Most people go through their entire lives believing that when they deposit money into a bank, that money sits there, waiting, safe, like a locker with their name on it. Banks even encourage this image. The word deposit, the word savings, the word account. All of it creates one mental picture. Your money in a box with your name on it. Here is the reality. The moment your money enters a bank, it stops being your money in any physical or legal sense. What you receive in return is a promise, a number on a screen, a liability that the bank owes you. The money itself, already gone. The mechanism. This is called fractional reserve banking. And once you understand it, you cannot unsee it. Here is how it works. You deposit 100,000 rupees. The bank is legally required to keep only a fraction of that, let's say 4%, as reserve. The rest, 96,000 rupees, the bank lends out to someone else. That borrower deposits their loan into another bank. That bank keeps 4%, lends out the rest. This cycle repeats again and again. Your original 100,000 rupees has now become the foundation for nearly 25 lakh rupees worth of loans circulating in the economy. Money that doesn't exist, created from your deposit, backed by nothing but the assumption that not everyone will ask for it back at the same time. The uncomfortable math. If every customer of every major bank in India walked in tomorrow and said, "Give me my money in cash," the system would collapse within hours. Not because banks are fraudulent, because they are functioning exactly as intended. The entire modern banking system operates on one foundational bet, that you will never actually want your money back all at once. And for the most part, that bet has worked for decades, across countries, across currencies, but it has also failed spectacularly. 2008, Washington Mutual, Silicon Valley Bank in 2023. Yes, bank in India. The moment enough people stopped trusting the promise broke. These were not accidents. They were the system showing its actual structure. The deeper layer. Now here is where it gets more interesting. When you keep money in a bank, legally, you are an unsecured creditor of that bank. You have given them a loan. They owe you that number on your screen. But in a bankruptcy scenario, you are not first in line. You are not second. You are somewhere near the bottom. Depositors in India are insured only up to 5 lakh rupees per account under DICGC. Anything above that, in a genuine bank failure, is at risk. Most people with significant savings do not know this, and most people with accounts under 5 lakh assume the insurance makes them completely safe, without realizing that even DICGC claims take time, involve processes, and depend on the health of the insurance fund itself. The safety net exists, but it is thinner than the marketing suggests. Zoom out. This is not an argument to pull your money out of banks. That would be both impractical and counterproductive. This is an argument for understanding the nature of the system you are participating in. Every modern economy runs on this architecture. Fractional reserve banking is why credit flows, why businesses get loans, why economies expand. Without it, growth slows to a crawl. But growth built on a multiplying chain of promises is structurally different from wealth built on something tangible. And most people are never told that difference. You were taught to save. You were not taught what saving actually means inside this system. Closing. So the next time you check your balance and feel secure, ask yourself one question. Secure in what, exactly? In a promise from an institution that has already lent your money to someone else, which that someone else has spent, which has been lent again and again, until your original deposit is somewhere beneath 20 layers of financial abstraction. The number on your screen is real. The money behind it is a chain of agreements held together by collective trust. And collective trust, as history has shown us more than once, is a remarkably stable thing, right until it is not.